Most traders believe you need to win 70% of your trades to make money. That's why they keep chasing perfect strategies and blowing up their accounts trying to avoid losses. But what if I told you some traders make serious money winning only 20% of the time? In this video, I'll show you how a low win rate trading strategy can still be massively profitable if you understand one thing most traders completely ignore. In this video, you will learn the expansion box strategy, the coiling pattern strategy, the momentum shift strategy. By mastering these strategies, you will learn how to identify and ride explosive market moves, capture trades with up to 1 to 20 risk to reward ratios, make money even with only a 20% win rate, spot institutional activity before major market moves. These are the same types of strategies used by some of the world's legendary traders. They can be used for both day trading and swing trading, and they work especially well in the stock market. Before we jump in, make sure to like the video, subscribe to the channel, and turn on the notification bell so you never miss future trading videos. Now, let's get started. Let's start with the first strategy, the expansion box strategy. This strategy was inspired by legendary traders like Minervini and Nicolas Darvas. The strategy is simple. First, I look for a strong growth stock that has gained at least 10% over the last month, the last 3 months, or the last 6 months. Then, I wait for the stock to enter a consolidation phase. Once the market starts moving sideways and building pressure, I wait for a breakout of the consolidation range. As soon as the breakout happens, I enter the trade immediately. My stop loss is placed at the low of the breakout day, and I trail the trade using the 20 simple moving average until the trend ends. This strategy can be used in different financial markets, but personally, I use it mainly on the daily chart for swing trading. Look at this chart example. This is the Intel Corporation stock. I took this trade last month, and I'm still holding it. Let's measure this move up. As you can see, the stock moved more than 55%, which is well above 10%. Now here we have a clear range, a tight range, the type of market I love, because when it breaks out, it can continue moving up for a long time. I drew the support and resistance levels and waited patiently for the breakout. Now look at what happened next. The market broke out of the range, and I entered at the close of the breakout candle with a stop loss just below the candle. I'm not afraid of getting stopped out because my edge comes from the size of my winning trades. That's what makes the difference in my trading account. Then I let the trade play out. Now look at what happened next. The trade reached a 1 to 42 risk to reward ratio, but because I'm a disciplined trader, I stayed in the trade. Right now, the trade is still at around a 1 to 35 risk to reward ratio. I will close the trade once the market closes below the 20 simple moving average. Now look at another trade that I took last month, and I'm still holding right now. This is the SanDisk Corporation on the daily chart. Now let's measure this move. The market moved 200% and then entered a range. Let's draw the range. After a strong move like this, we expect another move up, and that's the move I want to ride to make money. Here we had a breakout. I placed my entry at the close of the candle that made the breakout, with a stop loss below it, and look at what happened. I got stopped out, so I tried again with this strong candle. Look at what happened again. I got stopped out once more. Now we have another breakout with this candle and strong volume, so I took the trade again, fully ready to get stopped out if it didn't work, because I'm looking to ride the big move. I placed my entry at the close of the candle, with a stop loss below the low of the day, and then I let the market do the work. Now look at what happened next. As you can see, this trade is now making a 1 to 14 risk to reward ratio, and I'm still holding it. I will not exit the trade until the market closes below the 20 moving average. The secret behind success is not a 99% win rate trading strategy. The real secret is a strategy that allows you to make 20 times your risk when the trade goes in your favor, while losing only 1 time your risk when it goes against you. One winning trade with a 1 to 20 risk to reward ratio out of 10 losing trades is enough to make money in the market. Let's see another chart example. This is the Visa stock on the daily chart. As you can see, this move upward made 16%, so it is above 10%, which is acceptable in our strategy. Now the market enters a range. Let's draw the range. Now look at what happened next. The market broke out of the range, so we placed our entry at the close of the breakout candle, with a stop loss below the candle. Look at what happened next. We got stopped out. We then adjusted the resistance level. Now look at what happened next. The market retraced back, moved higher again, and broke out of the range once more. That's our entry. You place your entry at the close of the breakout candle, with a stop loss below the candle. Now look at what happened next. As you can see, the market started moving in our favor, and once it closed below the 20 moving average, we exited the trade with a 1:9 risk-to-reward ratio. That's how trading works. Small losses and big winners. The second strategy is the coiling pattern strategy. In this strategy, we will focus mainly on rectangles, triangles, and flag patterns. First, the stock must make a strong move of at least 10%. After the move, the market starts consolidating and coiling inside a tight range. The more the market coils, the more explosive the next move can become. Once price breaks out of the pattern, we enter the trade immediately and ride the momentum move. This strategy works because the consolidation phase represents pressure building inside the market before expansion occurs. Now look at this chart example. This is AAPL on the daily chart. As you can see, the market made a strong move higher. Let's measure it. This move pushed up more than 26%, which is extremely powerful and shows strong momentum entering the market. After that explosive move, the market started ranging and consolidating. So you draw a resistance level across the highs right here, creating a rectangle pattern. Remember, with this strategy, you always trade the breakout above resistance. Now look at what happened next. The market breaks above the resistance level, and you could enter immediately after the breakout, but the breakout fails and you get stopped out. That is completely normal in trend following. Not every breakout works. So what do you do next? You simply wait for another valid breakout, and, as you can see, the market breaks above resistance again. You enter once more, with a stop loss below the close of the breakout day. Now this is where trend following becomes powerful. Instead of taking profits too early, you let the market trend for as long as possible. Your exit rule is simple. Stay in the trade as long as price remains above the 20 moving average, and exit only when the market closes below the 20 moving average with a bearish candle. Now look at what happened next. The market continued trending higher for a long period of time before finally closing below the 20 moving average. That becomes your exit signal. This single trade produced a 12-to-1 reward-to-risk ratio. And this is why trend followers do not focus on winning most of the time. With a 12-to-1 reward-to-risk ratio, you theoretically need less than an 8% win rate just to break even. One massive trend can completely change your trading results. And with only a 15% win rate, you are already close to doubling your account. Let's do some math. Let's say you took 100 trades, and for each trade, you risked only 1% of your account. Out of those 100 trades, you lost 85 trades and only won 15 trades. So, 85 losing trades multiplied by 1% risk equals an 85% total loss. And now look at the winners. Each winning trade produced a 12-to-1 reward-to-risk ratio, which means each winner made 12%. So, 15 winning trades multiplied by 12% equals 180%. Now let's subtract the losses from the gains. 180% minus 85% equals 95%. That leaves you with a total profit of 95%. And this is the magic behind trend-following strategies. You do not need to win most of the time. You simply need small controlled losses, disciplined execution, and a few massive winning trends that completely change your results. Now look at this chart example. This is AVGO on the daily chart. As you can see, the market made a strong move higher. Let's measure it. This move pushed up around 12%, which is above 10%, making it a strong momentum move. Now we draw the resistance and the support levels, giving us this flag pattern. This is simply a temporary consolidation after a strong bullish move. Now let's wait for the breakout. As you can see, the market breaks above the flag pattern. You could place your entry either at the close of the breakout candle or during the breakout itself, with a stop loss below the breakout structure. Now, instead of taking profits too early, you trail your exit using the 20 moving average. As long as the market stays above the 20 moving average, you remain in the trade. Now look at what happened next. As you can see, the market continued trending higher for a long time before finally closing below the 20 moving average. That becomes your exit signal. This single trade produced a massive 15-to-1 reward to risk ratio. Now look at this chart example. This is VMI on the daily chart. As you can see, the market made a strong move higher. Let's measure it. This move pushed up around 13%, which is acceptable since our rule is to trade stocks that already move 10% or more. Now let's draw the resistance level and the support level. As you can see, we got this symmetrical triangle pattern. The market starts compressing, volatility decreases, and now we wait patiently for the breakout. Now look at what happened next. The market breaks above the triangle pattern, and that becomes our entry signal. You place your entry at the close of the breakout candle with a stop loss below the breakout candle. And now comes the most important part. You let the trade play out. You either get stopped out quickly or catch a massive trend. Now look at what happened next. As you can see, the market continued trending higher for a long time before finally closing below the 20 moving average. That becomes your exit signal. Now let's measure the move. This single trade produced a massive 27-to-1 reward to risk ratio. With a 27-to-1 reward to risk ratio, you theoretically need less than a 4% win rate just to break even. And this is why trend following can become extremely powerful. By using this method, you will not find trades every single day. Sometimes, you may only find a few trades per month, and some months you may barely find any setups because the market is ranging. But that is completely normal. Trend followers are not trying to trade constantly. They are waiting for explosive breakouts, strong momentum, and rare opportunities that can completely change their results. Sometimes, just 2 or 3 massive trends out of 25 trades can be enough to dramatically grow your account. Now look at this chart example. This is QRVO on the daily chart. This is the last bullish move. Let's measure it. As you can see, the market moved up around 13%, which is acceptable since our rule is that the stock should already move at least 10% before forming the setup. Now we draw the resistance level and the support level, giving us what we call a descending triangle pattern. Normally, a descending triangle is considered a bearish pattern. However, in momentum trading, we are not predicting the direction. We simply wait for the breakout and follow the price action. Now, let's wait for the breakout to the upside. Look at what happened next. As you can see, the market breaks upward aggressively. The close of the breakout candle becomes our entry, and the low of the breakout candle becomes our stop loss. Now, instead of taking profits early, we simply follow the trade using the 20 moving average. As long as price remains above the moving average, we stay in the trade. Now look at what happened next. As you can see, this single trade produced a massive 20-to-1 reward to risk ratio, which is exceptional. With a 20-to-1 reward to risk ratio, you theoretically need less than a 5% win rate just to break even. And remember, this trade could easily have failed, and you could have been stopped out quickly. That is completely normal in trend following. The goal is not to win every trade. The goal is to keep losses small, follow the trend, and catch occasional explosive moves that can completely transform your results. Now let's look at the third trading strategy, which is the trend line breakout strategy. This strategy can also be used in the Forex market. Look at this chart example. As you can see, this is the New Zealand dollar versus US dollar daily chart. The market started trending up, making higher highs and higher lows. This is the first point, this is the second point, and this is the third point. You connect all the points together, and now you have a clear trend line. Here we also have a strong resistance level. Now look at what happened next. The market broke above the resistance level, swept liquidity, and then closed back below it. This is the first sign that smart money may be entering the market. Now focus on the trend line. Look at what happened next. The market broke below the trend line. So now you have two important signals, a liquidity sweep and a trend line breakout. You place your entry at the close of the candle that made the breakout, with a stop loss above the high. The target is when the market closes strongly above the 20 moving average. Now look at what happened next. As you can see, the market started trending down below the moving average. Here, we don't have a strong close above it, it was only a retest. But here, we finally have a strong close above the 20 simple moving average. This is your exit. As you can see, this trade made an 8.5 to 1 risk to reward ratio. Trades like this are the ones that can significantly grow your trading account over the long run. You don't need to spend 8 or 10 hours a day looking at charts. You only need 15 minutes after the market closes. If the market closes strongly above the 20 moving average, you exit the trade. Otherwise, you stay in the trade and let it run, because these are the types of trades that can make you profitable in the long run. Now look at another chart example. This is the Australian dollar versus Japanese yen daily chart. As you can see, the market started trending down. Here we have the first point, and here we have the second point. Let's connect them to draw a trend line. Now look at what happened next. As you can see, the market reached the trend line, broke above it, and then closed back below it, forming this pin bar. You then adjust the trend line to touch the wick. Now look at what happened next. The market pulled back and then broke strongly above the trend line with this candle right here. That's your entry. You place your entry at the close of the candle, with a stop loss below the low, and the target is when the market closes at the 20 moving average. As you can see here, the market formed a resistance level, broke above it, and then closed back below it, creating a liquidity sweep, which is a strong reversal signal. The market then closed at the 20 moving average with this large bearish candle. That's your exit. As you can see, this trade made a 1 to 7 risk to reward ratio. If you can consistently catch trades like this, even a 20% win rate could significantly grow your trading account over the long run. Now, I hope you enjoyed these strategies. If you found this video helpful, make sure to like the video, subscribe to the channel, and hit the notification bell for more smart money trading content. Thank you for watching, and see you in the next video.